12 minutes to 8 on 3AW Breakfast. Two pretty big banking stories caught our attention this morning. One, of course, is the shareholder revolt against the NAB board yesterday at their AGM.
Fiery.
And also, it wasn't long ago that interest-only home loans were taboo, but now the banking watchdog has said to the banks, go for it. Go for it. More interest-only loans. So joining us is Martin North, who is a banking analyst from the Digital Finance Analytics. Good morning, Martin. How are you going?
Very good. How are you?
Good. Well, the AGM, the shareholders yesterday at NAB, what were your thoughts on that? And is this a sign of things to come?
Yeah, it's pretty remarkable. 88% vote against the remuneration plan that the board had put up. And I think it probably highlights the fact that shareholders are pretty dischuffed with how the banks have been performing. And particularly if you think about NAB, a year ago their share price was around $30. Now it's $23. And if you think of all the, bad things that have happened through the years, through the Royal Commission and all those things, really NAB has not been, functioning very well. So therefore the shareholders really have sent a strong message both to the board and to the senior management that they want change.
Martin, how nervous do you think execs at the other banks are going to be right now?
Well, it's interesting. So in fact, 3 of the 4 banks got a similar sort of warning at the shareholder meeting that the shareholders were not happy. CBA, who didn't put any recommendations in on bonus payments, escaped, right? But this is really a very critical inflection point in terms of the behaviour of the banks and the expectations of shareholders. And I think it says 3 things. Firstly, there's a lack of connectivity between banks and their customers, and I think shareholders recognise that. Secondly, the fact that there's been very poor behaviour and maybe even illegal behaviour, under the watch of those boards and executives means there's got to be change, I think wholesale change. And thirdly, of course, the Royal Commission hasn't yet reported, and we expect that to come out in February, expect significant change and transformation in our banking system. And I guess the question is, to what extent are the current executives in the banks able and willing to change?
The big question for me, Martin, is this a watershed moment in the history of Australian banking, or in a couple of years' time is it all going to be forgotten and the banks are going to get back to their old habits?
Well, I think that's a really interesting question, because we have a banking system that doesn't benefit most consumers. We get charged too much. Most of the banks actually are just worrying about shareholder returns and those sorts of things. And frankly, the Royal Commission said it was all about greed. It wasn't about customer outcomes. So I think it's more than just a little sort of blip on the radar. This is a fundamental opportunity to recraft our banking system in favour of Australia, in favour of consumers. And look, there's a very important role for banking and for credit in Australia, but we have to find a different model from the one that's been used for the last generation or two, because frankly, it has not done Australia proud.
Martin, we know one of the things that's been affected is lending. Now, the banking watchdog has axed the cap on interest-only home loans. Do we think that's going to have an effect, and what on? Is it going to affect property prices, which are clearly on the slide?
Yeah, so prices have been sliding and will continue, I think. Investors have been very nervous. Interest only was a part of the puzzle, but not a significant part. And to be honest, what's happened is that the regulator has basically replaced more sophisticated management of the loan portfolios from those speed limits. So the fact that the speed limit is now removed and the 30% cap has gone won't necessarily translate to a massive rebound. It may down the track, attract a few more people back, but frankly, interest-only loans are highly risky for borrowers, because they still have to repay the capital amount down the track, and the banks are still making tighter underwriting decisions even now. So my view is it's a marginal change. Optically, it sort of sends a message to say, things aren't maybe too bad, and they're trying to manage towards a soft landing of the housing market. Tricky to do, but actually I think in real terms this isn't going to fundamentally change the trajectory of home prices for the next 12 months or so.
Just a general question before we let you go, Martin. It's obviously very important to have the 4 big banks very, very healthy. It's important for a whole lot of reasons. But do you think we're going to see, particularly after the Royal Commission hands down its findings, do you think we're going to see more competition, more banks taking on the big 4?
Well, we're already seeing it. So we're seeing a number of fintechs, new technology-based banks beginning to emerge. We're seeing some of the regional banks and some of the smaller banks and credit unions beginning to assert their authority. The level playing field is tilting slightly towards those smaller players relative to the large players. And I wouldn't be surprised to see recommendations from the Royal Commission to break up our biggest banks into smaller, more manageable pieces, because I think the problem we have is that those guys are just way too big, too complex to manage, and frankly, they've lost the plot. So I think this is an opportunity to really shape banking for the next 10 to 12 years, and I think some of the smaller players and the newer players potentially can win out to the benefit of consumers.
Good on you, Martin. Martin North, the banking analyst from Digital Finance Analytics.